Welcome to AWM Insights. It's your Power 3. Actually, it's your Power 2 today. We've got one CPWA and a CFA. We're Brandon and Justin, and we're missing Eric today. But without further ado, we'll go jump into some of these hot topics we got going. And Justin, this week, as you always do, you're sending out some fascinating articles. And I think we both resonated and really stuck on this quote that we saw. And it's quote unquote, not politics, not fear, not greed, just math. And to me, this resonated because we've seen the arguments on both sides. Where are valuations? Why are things taking off? Why is DoorDash has no profitability, got a $60 billion market cap? It's a wild world right now. I'd just love to hear. I know we got a lot to dig into, but this past week, the IPO bonanzas, the predicting of the future, the vaccine, jobless claims. I mean, we got so much going on. What's going through your head as a chief investment officer, Justin?
Yeah, well, I'm glad you started with that. And we got to rib Eric first and foremost. We got the brains of the operation here today, right? I think that quote you highlighted is really a great quote, in my opinion, for the year as a whole. I mean, it's been a fascinating year, one for the ages, I would say, not necessarily for good reason. But, at the end of the day, I think we all need to look at the math. Now, I will admit that you can use math to reach any conclusion you want, or statistics rather, right? There's a quote that says lies, damn lies, and statistics. So you have to be somewhat careful and know what you're doing. But at the end of the day, to be a good investor, I think you have to be I don't want to say a mathematician necessarily, but you have to appreciate the math and the statistical side of it, right? Because at the end of the day, what we're talking about is probabilities, whether it's predicting the future, very low probability event, predicting how a company is going to continue to perform in the future, whether it's Airbnb or DoorDash, the two most recent huge IPOs, let alone DoorDash isn't even profitable. Will it get to profitability? Who knows, right? So you have to put all this stuff through a filter of math and statistics to make good investing decisions. And quite honestly, take politics out of it. We've talked a lot about politics around the election. Or I shouldn't say really politics, but the election specifically and its impact on markets. And at the end of the day, there's really no statistical meaning for markets depending on what party is in power, right? So you really have to, again, get out of your own head and appreciate the numbers, the probabilities, the long term when it comes to investing.
Yeah, I think that's a great point, Justin. I think, as I've had these conversations with clients and people throughout the past couple of weeks, it's always a reminder of, remember where you're getting your information as well. If it's marketing driven, most mass media is, they're naturally going to go to the polar extremes. I mean, I've had conversations about people leaving the country and, we're going to a communist state to, this is the greatest thing that ever happened. Right. And so, I think you have to kind of come back. That quote is coming back to reality to an extent and taking a long-term view, because in the short term, it just seems like everything can create so much volatility in certainly in the markets, but even more so, I think, in emotions, right? And good investors have the ability to probably not remove emotion, but mute emotion and make logical decisions. And it's something, I'm going to be the quote guy this week, but I was reading an article that Morgan Housel wrote from Collaborative Fund. And if people haven't read his book, Psychology of Money, huge recommendation there. I think it's a brilliant book. But he went on to say that if something is possible to know, you're better off not being very smart, because smart people fool themselves into thinking they know, while average people are more likely to say, I don't know, and end up closer to reality. And for me, it's another good reminder. I mean, if somebody out there is saying like, hey, Airbnb is going to be, over the next decade, the most unbelievable investment there is out there, or, I've heard so many times this week, oh, my uncle or my friend bought Tesla and they think it's going to X, or Bitcoin's going to X, that my response is always like, okay, that's great. Why? genuinely, if they've got some crystal ball and we could profit off of it, I want to know. But I think it's a great question to ask, right? Like, what are you basing your assumptions upon? And too often we just fall in love with ideas, become emotional around them, and then make decisions. And I think that leads to mistakes.
Totally agree. And it's not to say they could be right, but this gets back to the quote we were discussing earlier. The likelihood or the probability of them actually being right on, let's just say, Airbnb, because that's the hot topic of the day. The probability of them being right on that call is pretty low. Is it certainly a possibility? Yes, no question about it. But then it gets back to something we've highlighted in a couple other podcasts, right? Is that really skill, or is that just luck? And that's kind of getting back to your quote about just rather not being very smart, right? And then saying I don't know and ending up closer to reality. So I think it's also important to underscore kind of within this conversation where returns come from, right? Now, and I'm going to speak more broadly speaking for markets as a whole. We're not speaking individual companies here, but you can basically dissect market returns into three different categories, and this is based on a lot of academic research that we look at quite extensively. But category number one, and let's say it's the highest probability, is enterprise risk, and that's essentially getting access to the market in various aspects of the market, right? Large companies versus small companies, value companies versus growth companies. There's a lot of academic research that says, okay, those are actual sources of return that have a expected rate of return that has a high probability of occurring over the long term, right? How you define long term is a kind of esoteric concept, but let's say 5, 10, even 15 plus years. You can also have engineered risk, which is like leverage and illiquidity and things of that nature, and a lot of private equity and private markets, which we subscribe to, but you have to again look at it through a good lens or a sophisticated lens. But a lot of those private investments actually engineer their returns through things like borrowing money, leverage, or sourcing illiquidity, et cetera. And then there's another category which you could call manager skill, and that's active management. And is it really worth paying more for active management? Is it luck versus skill? Are these people able to really persistently earn higher rates of return over the long term for the higher fees that generally come with it? The odds are stacked against them. Again, going back to math and probability. So I'll stop going too deep down a rabbit hole on all that, but I think it's important to think about really where returns come from.
Yeah, I think and those are absolutely fantastic points. I think it's what makes this so difficult, right? For investors, you're getting bombarded by the media. Things are doing extremely well. I actually think this could be the most dangerous time to be an investor, quite frankly. I mean, especially if you're starting out, if you got enamored with DoorDash and you invested on, pretty early in the day, you had a pretty good outcome, and now you might be tricked into thinking that you know something special. I mean, we've run into this recently with a few young investors that have done well in the options markets this year because we've had all this volatility, and now they think they're going to make some great outcome. And I think the great analogy there is that's a lot like going to the casino for the first time, and we all know we all win the first time at the casino. I don't know how that happens, but you have a lucky day at the roulette table, and then over the course of your life you keep going back and you find out there's a reason why Vegas is so nice. It's an interesting time to be getting into these markets. It's tough. We're not going to downplay that. It's tough to sit there and say, you know what, I'm going to be a diversified investor. I'm going to globally allocate myself all over the world, and I'm just going to participate. That's not going to win you any arguments or get you any notoriety at the cocktail, at the bar.
Zoom meeting, right?
Yeah, the Zoom meeting nowadays, right? But at the end of the day, it does go back to the data and the math. And what we know is that a successful outcome as an investor, a long-term investor in the public markets, and we could go down the path on the private markets, but in the public markets is to be that globally diversified investor that is allocated to the areas of higher expected returns. We've talked about that, small value, profitability, et cetera. But but it's not as fun. So, I think it's if you need that entertainment value, sure, take a tiny sliver of your money and go get it. Bet, because it's just purely a bet on a Tesla or DoorDash, but make no mistake about it. Take the majority of your wealth, play this sophisticated game, play the game that's going to give you success over the long term. And I think you'll be a happier investor over time from there. So with that, we thank you for your attention again. We ask if you enjoyed this, head on over to iTunes, give us a like, share this with somebody. We'd appreciate it. If you got questions for the future you want us to cover, please send us a message. And I'll try not to mess this up for Eric, but stay humble, stay hungry, and always be a pro.